It's not easy to understand why stocks go up and down, but even in volatile markets, there's always a discoverable and logical reason behind price action. StoryTrading is a social investing community of investors who share information to uncover the hidden stories behind the trade through the 4 pillars of fundamentals, catalyst, sentiment, and technicals. All price action can be understood through the lens of these pillars, allowing for a holistic view that empowers better decision-making. Only by understanding markets can you beat them. Join our community today and start making sense of markets.
All right, good morning, folks. I wanted to start with that little overview of story trading once again, just to remind people that the reason we do these macro overviews is because it does impact our individual stocks that we're looking at. It is important. It is meaningful. When you look at the price action, that's what we're trying to do at story trading. We're trying to understand why a stock is priced where it is. Why is it quote unquote undervalued? Why is it quote unquote overvalued? Why is it going up? Why it's going down? And macro is one of those factors. And it's important to understand that so you can empower yourself to make better timing decisions, better allocation decisions. And normally in a stable market, we don't really look at macro. We're looking only at the individual factors of that company. But this market's not so stable. There's some major macro concerns out there. So it's important we look at this. Now, I'm going to spend most of the time here talking about the NASDAQ. There are a couple news items out there, but we're going to go a little bit slow today to make sure we capture everything. So you guys have been following me, who have been following me, know that I've been bearish on NASDAQ for quite a while to at least reach this 200-week moving average, which is that pink line over there, right, which is about 265. I just want to talk about this concept for a second, which I've mentioned repeatedly, is that to me, this 200-week moving average is a bull market support line. Okay. Because you can see every time it's gone near there and touched it, it's gone straight back up in this 5-year chart. Now, soon I'm going to show you a max chart to 1993 on my desktop. So we'll get to that in a second because I found something very interesting. So, what we've seen so far, in my opinion, is not a bear market. These definitions of like 10% for a correction, 20% for a bear market is meaningless. It's wrong to me because it doesn't include the context of where you came from. How steep was the ascent? How big was the magnitude of the ascent in the bull market just prior? And you need to look at that context to then decide, well, how much of a drawdown is a correction or a bear market? And so far, the NASDAQ, because it's staying above the 200-week moving average, has been in a bull market. And the same for Apple. And that's important from a psychology perspective and an investor behavior perspective, because it means people are still making a lot of money. All right. Certain people, not the ones who are stock picking and going to growth stocks. It's only been a week or so that I'm starting to get text messages and calls from family and friends who are starting to get a little concerned, but they're still not panicking. They're still not pulling out of the market. Why? Because they're still making big money. Because the average investor, they invest in SPY, QQQ, Apple, and that's about it. Okay. So everyone's still kind of sitting pretty. The panic hasn't started. Still in a bull market. All right. So I talked about this is just a technical correction at this point, and we'd have a technical bounce off the 200-week moving average, and then there was a recession or a bad macroeconomic situation, it could go below the 200-week moving average. Now, we're basically there at this point, right? Whether, even if right now is the bottom, which it won't be, okay, right? I think we made the case for that. We predicted that long ago that we're going to crash in the NASDAQ. First, I predicted an RK, and then the NASDAQ would follow. And I said, how did we get there? We get there by Apple going down and correcting. And made the forecast that would happen because of reduced consumer discretionary spend due to inflation. Another factor I didn't totally foresee was profit margin compression, which now we're seeing in a big way. Started with Amazon, then Target, and Walmart, right? We saw the reduced consumer discretionary spend starting with Netflix. All the stuff is starting to come, and now the skeptics are getting that quantitative data to become believers and understand there's going to be a bear market, and this is why Apple's crashing. I mean, it's unavoidable. The higher expenses are going to impact Apple. They're going to be selling less stuff, less gadgets. Okay. And let's look, by the way, where's the 200-week moving average on Apple? It's all the way here at 96, 97, 98. Okay. There's some congestion here in the chart there, which can serve as support in like the 112-ish, 110, 115 area, I would say, right? 110 to 115 area. So I think that's a very near-term target for Apple, in my opinion. There may be some holdouts. People are still in the green. They may want to see more data, but that data is going to happen. I don't see how it doesn't happen. That data will come out, whether it's from third-party data that people are putting together, or analysts lowering it, or eventually Apple coming out and warning. So 112 to 115 is going to be minimum for me. And I talked about this. This is the COVID excess has been taken out of every other sector except the QQQ, the SPY, and Apple, basically. Okay. And so that has to come out. All right. Now, what happens after that, though? And this is where what I want to talk about. I'm going to share my desktop screen here because this is a very important find I made last night. Second. All right. Check this out, guys. Unfortunately, my phone only goes back 5 years on charts, and that's where I'd like to be. I just like the user experience interface much better on my phone app. I said, you know what? Let me throw up. This time I went to SPY instead of Nasdaq because SPY is starting to break down. So I said, let me look at SPY and the 200-week moving average. And first thing you notice is look at this great support, right? Boom, boom, boom. You see, is my cursor showing? There it is. Okay. Right. Look at this great, wow, long-term support. This is the COVID crash, right? It was kind of like a bear trap, I guess, right? Went under it. Look at the other 2 times it went under it. Only 2 times since 1993. The dot-com bust right here went under the 200-week moving average. And then what happened? It stayed under the 200-week moving average for about 2 years. And the financial crisis, see, support, 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 support. Financial crisis went below the 200-week moving average and stayed under it for 2 years. And then support, 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 support. These, in my opinion, are the only 2 bear markets on the chart since 1993. Forget about 10%, forget about 20%. Okay, bull, bull, bull. Bearmarketpop.com, bear market pop financial crisis, and then bull market all the way through. We had COVID, which, you know what happened there. Okay. So now, right here, we're over here. This is just a technical correction, and you would bounce off that. You're in a bull market. But this is where I said we got to now watch that closely. What happens after we reach that 200-week moving average? Is there something fundamental in the economy, a macro issue, which would cause you to go in a bear market? And history tells you if you go in a bear market, it could be multiple years till you break back above the 200-week moving average. And I think that's where we are. I think this week, yesterday was the day that took people out of denial and convinced people that inflation is going to have a meaningful impact on earnings and take us into a bear market. And I think we're just at the beginning of it with what we're seeing with Target and Walmart on the cost side. I think you haven't really even seen it so much on the discretionary spend side, right? I think you're going to see discretionary spend go down significantly in the coming months and really solidify a macro issue and take you into a bear market. Now, you know, a lot of this is geopolitics. If it was just inflation and the free money, you know, they gave us, they can raise interest rates and it's a cycle and you get out pretty quickly, in my opinion, right? But we have the exogenous risks that are caused, exogenous factors which are causing stagflation, that being supply chain issues from China and that being what's going on with the Russia-Ukraine war in terms of energy and food. Those are things out of the control of the Fed, has nothing to do with interest rates. And I don't think, or at least you have to start pricing in the possibility that these are not transient. right? Even if we think that the China situation with COVID and the supply chains is completely innocent and they have no bad intent in what they're doing, right? Even if you believe that, America has seen the consequence of relying on China. And I think you're going to see a big push for manufacturing to move out of China, perhaps a lot of it back to the US. And what that means is higher costs permanently, right? It means smaller profits. It could mean a lower quality of life for Americans. We enjoyed this unprecedented bull market because we were able to get things cheap out of China. So right now, you got to call that into question. And again, I'm not here to tell you it's definitely terrible. I'm telling you it's got to be priced in. There's a certain percentage chance, and I think it's relatively high, but you can quantify it for yourself and see what other people are thinking out there. That will have persistently high prices because of some geopolitical issue with China, and that's going to hurt earnings, and we're going to enter a bear market, and we're going to have a stock market like this for multiple years. I don't know if that's 1 year, 2 years, could be 3, 4, 5. I don't know. Maybe it could be a decade. This is a gigantic structural thing that has to be worked out in terms of supply chain and costs and where we're manufacturing things. And, that's one issue. And obviously you have the Russia-Ukraine issue, which I'm a little less concerned about in terms of energy, because America has all the energy it could ever need. Maybe we need some policy changes or something here in the States, and I think that'll work itself out eventually, maybe faster than the China issue, honestly. I know that probably at odds with some people, but that gets priced in quickly if there's a policy change, right? And so the supply doesn't have to come on right away. But as far as, if the market knows there's a policy change there and we're going to be drilling, we're going to be opening up land, deep sea drilling, whatever it is, I think that could self-correct. I'm more concerned about food. I've been talking about this for a long time. I think the food inflation, even though America has all the food it ever wants, it's being priced based on the global price. Wheat, soybean, corn, all this stuff that America is exporting is in super short supply all over the world, and it's causing wars, it's causing riots. It's going to, right? Already you see it in Iran, what's going on. I'm sure it's a lot of other places in the Middle East and Africa. And if you don't think, let me put it this way. The issue with high food prices is that it's unprecedented, which means there's an uncertainty, or there should be an uncertainty in the macro environment here in the States that need to be priced in. And uncertainty is crypto for stocks. That uncertainty is, how will the consumer react to consumer discretionary spend if food prices stay elevated or keep on rising, right? To me, I think the possibility exists because this is something so unprecedented that consumers have never seen in America, and food is the number one most important product you could ever buy. Okay, that I think it's possible there's some severe consequences in terms of consumer discretionary spend, that people will really tighten their belts, people live paycheck to paycheck, and then people even a little bit above that who maybe have a cushion, but they've never seen egg prices and bread prices and all the food prices going up in such a dramatic fashion week after week. What's that going to do to their budgets? What are they going to spend and what are they going to cut, right? So I think this is a major macro issue that I'm very concerned about. So basically, to me, this is an inflection. What happened yesterday, and I predicted that it would come, but now that it's here, it's different. And now that the market recognized it, it's different, right? It's very clear to me that yesterday the market recognized that we're going to have earnings compression all over the market, and it may be sustained. Okay, so that's why I'm thinking this is no longer my target. The 200-week moving average is a technical correction. I think we get there. It's going to be today. I can't predict on a day-to-day basis, but probably within the next few weeks, could be the next few days. Maybe I'll have a bunch of bear market rallies in there, or pops, or fake pops, or I don't know, squeezes on OPEX. I don't know, right? But I think we're rapidly going the 200-week moving average, which is going to be that correction area. I would hope that we get a bounce in there, a tradable bounce for people who want to do a little bit of trade or delever or whatever they want to do over there. But that's not guaranteed. I went back and I zoomed into that .com chart over here, and you can see in the two times we broke in the .com, there was no support at the 200-week moving average. It just went right through it, and then it went right back above it. Right, man. A lot of people got broke in that move when it went back above it. They're like, "Oh, it's all better now," and then boom. And then the financial crisis, he had a lot of support. It actually tested the 200-week moving average twice. That looks like it maybe a quarter it took at least to actually from the time it tested it to the time it breached, right? So I don't know which one of these forms this will take. I have a feeling it's going to be more like the financial crisis, not right through. I think it will take a couple quarters based on the choppiness we've seen to date so far. It seems like this market decline is being very controlled. Market makers are doing a good job. They're making sure everyone's options and put options expire worthless. I think that's what's going on. I think they're managing the decline. And I think there's still a lot of skeptics out there or deniers out there and people in denial who want to see the data, right? They want to see they're not going to sell until Apple comes out and warns or something. And then you'll see Apple go from like 140 to 115 in like 2 days, right? So I think that's where we are. So I'm kind of downgrading my prognosis right now to say, yeah, this 200-week moving average is just an initial target. And I think unless there is a reverse black swan, or I don't know if that's called a white knight, but unless there's like a reverse black swan, then I think it's all but guaranteed we end up in this bear market and we have a rough time for multiple years. That's where I'm at right now. That reverse black swan can be like war being resolved. It could maybe be some sort of normalized relationship with China. I don't know, like China come in and say, well, we're never doing lockdowns again, and we love America, and we love Biden, and we're dedicated to making everything cheap for American manufacturing. I don't know, like something like that, like overnight, right? If something like that happens and or, the war gets stopped overnight, then maybe you end up in a position where we can quickly regain that bull market trend. But I'm not counting on it. And in the meantime, why is this so important? It's because, let me switch again, go back to my regular stock lists. It's because these macro factors we just talked about impact almost every single stock. Every single stock, you have to make a legitimate bear case and price in a legitimate scenario where what's going to happen to consumer discretionary spend, how's that going to impact my stock, and what's going to happen on the cost side with margin compression. And it impacts almost everything, even all of our favorites, including DRIO, one of my favorites. That could definitely be impacted in a bear market as well. I'm not going to go through all the exact reasonings, but even Smith Micro, which I've talked about, almost every single stock, even VTSI can be impacted if we get into a situation where tax receipts get so much lower because people aren't making money and municipalities have less money, even though it's a product which shouldn't have an impact in terms of demand, but maybe certain municipalities won't just have the budget anymore to buy VTSI products. And of course, don't forget, the cost side for what VTSI is building and, the components coming in. They have hardware in addition to the software. So almost every single stock can legitimately be impacted by macro concerns. So when you see the NASDAQ down and the SPY down and you flip on Bloomberg or CNBC, whatever it is, and they're talking about these macro concerns, don't think for a second, oh, markets are inefficient and it's just stupid that my stock is going down. It shouldn't go down. Yes, it should. It should go down and it will go down. Okay? So just be careful of that. And look, I'm keeping most of my favorite stocks. I'm probably going to keep all of my DRIO. But I started yesterday finding every corner of my portfolio things that were like not my top convicted positions. And I was selling them and buying PSQ, shorting the NASDAQ by one time. Not doing SQQQ, not doing. Very hard to make money on that. It worked in the COVID crash. That was a very unusual situation with the COVID crash. They're managing the decline. They're burning everyone's puts. It's very difficult. So PSQ, single short NASDAQ. is what I'm doing. And I'm going to continue it today. I don't know if I'll get there. I was like 100% invested until yesterday. I'm like, maybe I got to 5-7% short position on PSQ. I'd like to be at 30 to 40%. I don't know how I'm going to get there. Going to have to make some tough decisions. So that's the story with that. And pay no heed to, if the market goes up today, don't get excited unless something fundamentally changes from a macro perspective. What is it, a reverse black swan? If it's not, don't get excited. Take that as opportunities to sell covered calls or reduce your positions and get into more of a hedge position, in my opinion. Now, a couple things. I'm not an expert on bonds, and this really had confused me the last several months because I always thought like TLT was supposed to be like a hedge against the market, and it wasn't. It was going down. There's lots of commentary of that 60-40 portfolio. It's not working. Bonds were going down with equities. I don't know anything about it. I don't know why it didn't work. I understand it had something to do with high inflation. But look what happened in the last several days. The TLT has started acting like a hedge again, and it's moving inverse to the market. And technically, it's gapping above the 20 DMA this morning. Now, first time in a long time. Now, last time it gapped above the 20 DMA. Look, I love these DMAs because I bet you this is making a move to the 50, which is around 124 and dropping right now. Will it break there? Is this just maybe it just keeps resuming down? I don't know. I don't know enough about the macro to understand how bonds work in TLT. But technically speaking, this break looks like it's good for a move to 124. And maybe this is somewhere to hide. We didn't have somewhere to hide in a long time. Maybe bonds will finally be that balance to the portfolio. If somebody looking at that, if you understand bonds more than I do, maybe that's for you. And you can take a look at that. Now, a couple individual stocks to look at with some news. SQM, I'm not familiar with it, but it's a lithium stock, and they had earnings, and it was good earnings. So look at that. I still have exposure to some lithium names, so maybe the lithium stocks will give you an opportunity to do whatever you'd like to do with that today. Okay, trade it, whatever you want. DRIO had news. Signed 2 new customers, one of them being a pretty large employer out of Texas with 70 employees in 17 states. So that is interesting. Of course, like I said, even DRIO has a bear case in a bad macro environment, right? We're not going to go into the details of what they are right now, but be aware of that. Okay. TFFP got an upgrade today with a $22 price target from H.C. Wainwright, and it's been acting pretty good the last several days. As you can see, maybe we got to bring Dan Carlson back. I think there was an insider buy in there. For whatever reason, TD does not give me insider buys in here. But I think Dan posted something yesterday on Twitter that there was a recent insider buy here. And did they have earnings recently on May 11th, right? Said earnings on May 11th. I don't know if there was an insider buy right after that. Now you broke the 20 DMA. Now you have an analyst saying 22. One potential bright spot in a bear market overperformance is health. The health space could do better. Yeah. So that's one of the reasons I like DRIO. The DRIO, I think it's recession resistant, not recession proof, recession resistant. And TFFP, same thing. So those are 2 interesting names to look at. SMSI did well. I failed to talk about it yesterday. StoryTrading got an article, went out through Benzinga, and it hit the news feeds. It didn't come on my mobile app for some reason, but everyone else saw it, like on desktop apps and different platforms. It came through the T-Mobile ticker and the AT&T ticker, and you can see what it did in the morning on price. Slid down. The market took it down. In the end, it was kind of flat, so that article helped a little bit. So that's SMSI. That's explaining the price action there. So that's all I got for you. We got 5 minutes till the open. So I don't see anything. Coil Energy Solutions to provide hydrogen energy services. DPDW. This is a microcap deep sea drilling company, or at least they provide equipment for deep sea drillers for oil. And they've had a nice run of good news recently. The earnings were not great last week, though. But this is an interesting headline to look at, maybe. But anyway, that's what I got for you. And to was very meaningful from a macro perspective. I've changed my mind. I no longer think the 200-week moving average is going to be the bottom. Not that I ever did, but I didn't even want to question what happens next. If you remember, I was like, let's get to the 200-week moving average first. That's just a technical correction in a bull market. Then we'll consider. All right. I think we have enough data. What happened yesterday, what happened this week with earnings is now enough data to tell me that we're likely going to break below this 200-week moving average, whether it takes days, weeks, or could take quarters. Okay. So be careful. Like, don't jump into put options, right? And the caveat is there going to be a reverse black knight? Black knight? Reverse black swan, white knight. All right. So do what you got to do. You don't have to agree with me. This is my opinion based on what I see. But all of these things help me to understand markets and understand price action. I think the more research you do, the more opinions you listen to, the more you can understand why stocks do what they do. And that's really my goal at Story Trading, so everyone can understand the story behind the trade, understand the price action behind the trade. And with that, if you want to be a VIP and get access to these videos in real time, you could do that by going to StoryTrading.com and upgrading to our VIP plan. And then you can not only get these videos in real time in the morning, but collaborate with myself and many other very smart people in our WhatsApp groups. And other than that, we do publish these pre-market preps at 4 p.m. every day. So, all right, guys, have a great day. Good luck. Bye-bye.